Okay, so if you don't know, talking about the term structure of interest rate hike. There's a nice little tool that does all the math for you, and you can see what the market is pricing. And indeed, he's saying that the market is pricing zero for a second hike. You go see what the current rate is, right? You hit current, tells you 500 to 525. You hit probabilities, and the blue line is the target that the market thinks is most likely, right? So it'd be along here. That would be most likely. So this is because we're at 500, this would be the second, that'd be the first hike, which would be in July. Then the second hike at 13%. We don't know at what time that was. Oh, it was a little bit ago. 25 basis point in July, then a pop in another case, a 25 basis point, no pop in place. Maybe he's thinking follow with that, so that would put you in November. So maybe it was zero earlier in the, but it's still pretty low. This term structure thing you can do from any asset that you're trading. You can take the prices of the derivatives and come up with a term structure of what date and what time the market thinks certain things are. Why do you want to do this? Because then you'll know if things are. It starts with a P. Anybody want to guess? Because if you bet on something that the market already thinks is going to happen, what's that called? What do you guys think that's called? No. Poop? It's called these nuts. Thank you, Chrome. Got it. We'll give you some points. Priced in. Right? Have you ever bought earnings and you're like, I'm going to buy puts because it's going to go down, and then it goes down, and then you're like, I didn't make any money? Well, that's why. Because the market already thought that was going to happen. So instead, what you needed to do by that date of those options, so what you needed to do was buy the stock instead. That way you bought the spot instead of the derivative. So depending on, or sold it rather. So that's just what you want to do. So that's how you split up where you bet. You either bet something's going to happen or what the effect is after something has happened. How do you do that? You buy the spot, buy or sell the spot, which would be the stock, or in the case of a commodity, it would be like you could buy and sell on the cash market. You have a really good broker. Maybe on RB. I don't know. Do you see what I'm saying? And for interest rates, what would be the spot market for interest rates? Like you could buy a really short-term duration bond, right? You guys can't really, none of us can buy and sell on the futures uh, or trade back and forth cash on the futures or the FFR market, because that's only a market available to banks, right? Where they overnight lend to each other or to the Fed, right? You're not a dealer, so you would never have access to that. But you could find proxies, right? And depending on what you think is going to happen is where you trade it, right? I can't answer that. You dork, any question for me? If you combine it with a buy, sorry. I'm not licensed. I'm a retail piece of shit trader. Thank you very much. Oh. In the United States, you cannot make recommendations to buy or sell. You're not licensed. And if you're curious about how to build one yourself, they have a whole thing on how to do it. Whee! Pretty cool if you just hit methodology. So that's the kind of stuff I do. I find it makes way more sense, but March 2023, median cash balances were roughly 10 to 15% elevated for every income quartile, with very little difference across the income. Yeah, but this is inaccurate because I think Biden just forgave a bunch of student loans. 60 million people? Oh, it's dead. I shorted with 1,000 NVIDIA. It's like down 80%. The real timing, like I said, is 6 months. So from when I said it. So we're now at 4 months. It's based on magazine covers. So where are they? So date calendar, roll 20. Eh, you don't win them all. If people think you have a 100% win rate, that's And you guys got to remember that win rate is October 22nd. A while ago. 1,000 shares short at 285. Really, what you're trying to do is asymmetrical bets, and asymmetrical bets are not just win rate based, right? Because then you wouldn't be betting in the stock market. You would go to something like binary options, right? And the stock market is not a like a sports betting machine. You would do sports betting. What? You gotta some sports betting has magnitude in it. I don't know. I don't sports bet. I don't like going near casinos. Casinos are non-random events. Like where the house has an edge. Like unless you have an edge, there's no reason to like bet in it. Just like everyone asks me, they're like, why don't you like to go to the casino? And I'm like, because I don't gamble. Well, you trade on the stock market all the time. Not the same. I see that. 1,000 shares and that's a lot of money. Close to a lot of money. Why? So on my sizing, I never take more than 10% of a portfolio on one position. 283 times 1.1 would get you to the size of your portfolio. Divided by 0.9. I can't remember. Oh my god. I don't even want to look. I hope you have that big of an account. That was around in 1999. Oh man, we had a total blast to the past. I was looking at restatement reports from 1999. Okay. Would you like to know a cool fact about NVIDIA? Yeah, I think so. But that's just me. In 2006, NVIDIA said all financial statements since 1999 IPO should no longer be relied upon. For me, it's just restatements are such a bad red flag. Oh, absolutely. Don't ever do anything based on what an idiot says on the internet. Okay? Namely, me. Okay? Why do I say that? Because I need triple D's in chat. All right? Triple D's in chat. Please. Triple D's in chat because we're going to get a little lesson. Okay? Triple D's in chat. Please. Just one. There we go. We got one. We got two. We got three. Can I get a four? Oh, 4, 5. What's triple D? Don't ask. No, I'm just kidding. No, boxer. Good. How many? 5, 6, 7. 7. 7. Big D, little. No, fuck off, boxer. All right. The triple D's stand for. Okay. No, I'm not drawing boba. Okay. Get your fucking minds out of together. Do your own damn due diligence. That's the triple D's forever and ever. Remember that. No, it's 3. Come on, it's better as triple D's. Come on. Fuck off. Fuck off with your details, chat. But triple D's is better. You're gonna remember. Come on. You're gonna remember. Come on. Double D's are the best. Quad D. Fine. How you doing, Walrus? Fine. Fine. Okay? But seriously, do your own damn due diligence. There is no reason to believe people on the internet. You shouldn't have a thing where you follow people. No shadow traders. You know what I mean? Get your process together, get your trading journal up. You paper trade, or you could do it with one stock. You could literally do it with one stock. There's even fractional shares now. Do you know what I mean? I think that is the best policy. That's how you're going to survive. That's how you're not going to blow accounts. And fair, I lost the original intention with the stream, which was I wanted to come out here and share my knowledge because I don't want you to make the same mistakes that I did. Most of this stuff is because I fucked it up. You guys can make fun of me while you're thinking of me, then you cannot do it. How much D is too much D? There's never enough D, Willie. Whether you're given or you're taken. All right. Now, don't take that D and say instructions unclear, stuck dick in wood chipper. Okay? Because a wood chipper wouldn't be great. And that's shadow trading. Thanks for fucking up in the past. Look, I incinerated what? Incinerated about 1,000 for trying to short NVIDIA early. I fucking knew it. Traders make mistakes too, you know? Or it can be part of your win rate. But that is also the nature of asymmetrical bets, right? You're not looking for a win rate only, you need magnitude. You have to think about a magnitude, right? Think about a money tree that 99 times out of 100 pays out $10, right? Put it in green. And then 1 out of 100 times it makes 1 million. Let's say your bet size, your bet into this is $10, right? So you're trading even 99 times out of 100. Should you make that bet? Put 1 for yes, 2 for no. 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 What is the question again? Okay, I couldn't read it. The question is, if you had a money tree that 99 times out of 100 paid out $10 and 1 time out of 100 paid out $1 million, would you bet $10 for a chance at that money tree? That was the question. We have a lot of wants, right? That's what happens is when you go out into social media and you search for people who are really right about things, consider that maybe you are not looking at the right thing. Because this would be the payout of all payouts to pay down $10 and get $1 million return on 1 out of 100. I do it. I do it day in and day out. But the idea is you need to do it 100 times and making the bet size small enough so you can survive to the 100 times bet. That's where the money happens, is you've got to survive. If you're incinerating cash, you have to incinerate it at a small enough time so that way you can eke out your edge. What you're trying to do is learn here that you do your own damn due diligence. And part of that is realizing that win rate is part of it, but also the magnitude of the bet matters too. And a lot of it is timing as well. When did that person get in or out? Is it an ex post trade or an ex ante trade? Ex ante would be before it. Binary would be it pays out on yes or no, whether it won or not. An ex post would be the effect after. So you have to consider all those. And that's why you need to do your own damn due diligence, because no one is going to set it up this way. I have not seen a content creator that talks about it this way, which is insanity to me, but whatever. Okay. So I just wanted to take that time to share knowledge that I think I have. And when you're betting out there, look, if something that you're doing is working for you, do not let me fuck with your brain that you mess with that strategy that you have. You do what you do. You know what I mean? Like,